Okay, now we're going to really start to get into the more, I wouldn't say complex, but the more complicated concepts. And we're going to do so by using things that we've learned. So, namely, a lot of these are applications of the balance sheet, which we just learned how to interpret. But they will also take from the income statement portion. So, make sure, at this point, you're comfortable with at least reading and understanding the different parts, where to find information for the income statement and balance sheet. And of course, we'll practice, so hopefully that makes things easier. Um, and you can come back to these videos. So, unfinanced capex, it's a term that sounds very complicated, but really is quite simple when you break it down. It's something that applies only to businesses. So let's look at the first word, unfinanced. So the word finance, right? When you talk about financing like a car or a house, you mean that financing something means to either when you're to lend money or to borrow money, right? So if you're financing um, if you're financing a house or a car, it means you're taking out a loan to buy that car or house. But if you're on the other side, you're selling it via financing. That means that you're lending money, right? So unfinanced, when you tag "un" in front of it, just means that you're not. It's not using borrowed money. You're just using your own money to buy something, right? So if you have $50,000 sitting in the bank account, maybe you can use that to buy a new car. Just use the straight up cash, right? So you don't have to borrow any money. And then capex is kind of a combination of and short form combination of the phrase capital expenditure, as you see here. So capital expenditure, it sounds a little bit complicated, but capital expenditure just means spending, right? It comes from the word expense, right? Expenditure, and then um, capital, when it in this context, spending capital expenditure means spending on capital. Capital, when it comes to a company, means stuff that the company needs, like actual assets. So I would say this, you can think of this as assets. Um, like for example, um, like machines or facilities, uh, a lot of those assets that the company will need in order to run its business, equipment, stuff like that. That all can be described as capital. So when we think about capital expenditure, you can think of the term as spending to buy assets that the company will need in order to do its business. All right. So some companies require more capex, or I'm just going to use the word capex because it's easier to say. So some companies spend more capex. For example, a car manufacturing company will need a lot of those robots to put the cars together, right? So those kind of car manufacturing plants, the capex is probably like billions of dollars, right? But whereas on the other hand, if you're running a business where you're just teaching, let's say you're tutoring math, right? Your expense is going to be the salary you pay to the workers that are teaching, but are you going to have a lot of capex? Like, are you going to buy a lot of stuff to teach with? Well, if you need projectors, that's capex, but generally, if you compare teaching a tutoring center to a car manufacturer, probably the car manufacturer will have more capex. But some companies won't have a lot of capex. Some companies will need a lot of capex. So that is something that is specific to a business. So why do I have this random detective icon down here? It's because it's something that we have to calculate, that we have to read both the balance sheet and the income statement in order to deduce. There's, of course, if you have a cash flow statement, that's always the easiest. Okay, so I don't know how to make a note out of that, but always go by the cash flow statement. But you have to know how to calculate it if you don't have a cash flow statement. And this is what we're doing in this lesson. So why is the unfinanced capex so important, right? So remember how we said, just to revisit, like EBITDA. EBITDA is cash flow that a company has in order to pay its debt, right? But let's say that we didn't deduct a lot of things. you, we calculated EBITDA, but we did not deduct capex. So we do need to deduct the amount of money that the company paid for capex in order to buy equipment. If the company paid using their own cash, that takes away from their overall cash flow. I don't know how to describe this, but let's say, like, remember the analogy where you have a certain amount of cash to do stuff, and then you have to pay your rent, you have to pay your utilities, you have to pay your car insurance. Remember that example that we used, right? But let's say one year, all of a sudden, you realize you need a new laptop. You don't need a new laptop every year, but that year you need a new laptop for school or for work. Then if you pay for that laptop out of your own cash, that's less cash for you to pay your mortgage, your car loans, etc. And really, this is the same thing for a business, right? We want to know if that year they use their own cash to buy some equipment that they need. That's gonna have to take away from EBITDA, right? So you're gonna remove this unfinanced capex. I'm just gonna short form it, right? Capex, unfinanced capex from EBITDA, right? To get the real amount of cash flows, the adjusted EBITDA. I don't know if you remember that, but there's a lot of adjustments that we typically make in commercial banking and in finance overall. But this is one of them. So hopefully that makes sense, and we'll just move on with an example. All right, so here's kind of a formula for unfinanced capex, and I wouldn't get too caught up in the formula. I would try to really understand what you're looking for and what you're trying to solve. So on the left side here is a really simplified version of unfinanced capex. Unfinanced capex is just whatever capex you need, a company needs, then you subtract the amount that they borrowed, and then you get unfinanced capex, right? You take away the financing. You make the financed capex unfinanced, right? That's why you subtract the financing. But the tricky part isn't the financing, it is more so the capex, right? The capex. So that's why we have this whole part of the expanded equation to calculate capex, because this is how you calculate capex. You take the plant, property, and equipment, or like, the capital assets, the non-current assets from this year, subtract it from the PP&E last year. PP&E stands for plant, property, and equipment. It captures, facilities, equipment, machinery. It's just one word that captures all of that to make it easy. And then you add amortization to figure out capex. So I'll kind of give you an example, and because this is it's really confusing, and it confused me too when I first was trying to digest the concept. So let's say, let's say you buy equipment and it's 100,000, right? So a company buys a $100,000 equipment. Amortization, as we talked about, is when equipment kind of every year it loses value, right? It loses useful value because it starts rusting, and it's, at some point you need to replace the equipment. We can think of our phones, right? You're not going to use, an iPhone for maybe 10 years. You're going to use it for like 2 or 3 years, and then you have to replace the phone. So in order to capture the loss of usefulness for that machinery, equipment, or property, you have to remove some value, and we call that amortization. So let's say we bought this new equipment, and its amortization is, let's keep it simple. Let's say it amortizes $10,000 per year, right? So that means if this was year one, okay, the next year, in year two, how much would the PP&E be? It would be 90,000, right? Because you just lost $10,000 from amortization. Okay, and that amortization expense is an expense item. That's actually going to be written on the income statement for this year. It's going to be showing on year two. Okay, so the year two income statement will have the $10,000 amortization expense. Hopefully that makes sense. So let's say, like, on the balance sheet, right? On year one, you bought it new, so it's 100,000. On year two, you're gonna expect this equipment to be 90,000, because based on your internal, like, there'll be somebody who decides how to amortize the equipment. That's a whole other topic. Like, it's actually something that it's not an exact science. It's something that people try to estimate, and they either do it the same amount every year, let's say 10,000 a year for 10 years, or they do it on an accelerated basis. If they say like some equipment loses value really, really fast at an exponential rate, then it's a different amount. But you don't have to worry about that because the amortization will be reported to you on the income statement. Anyways, getting back to the point. So in year one, let's say you have 100,000. In year two, you're going to expect to see on the balance sheet PP&E is going to be 90,000, right? Because you have this 10,000 amortization. But what if instead of 90,000, you still have 100,000 recorded? Okay, you still have 100,000. So that doesn't make sense because you amortize 10,000, but how do you still have 100,000? So that's why the only logical explanation is the company spent $10,000 to buy new equipment. Okay, so this is spending. So if you expect the equipment they already have to amortize $10,000, you're expecting it to go from 100,000 to 90,000, but instead it's still 100,000. Then the only logical explanation is that they bought more equipment over the year, and this is what this formula is trying to solve. You're subtracting this year's PP&E, right? So PP&E this year would be 90,000 in this case, and then you're subtracting last year's PP&E, which is 100,000, right? And then you also have to add the amortization because assuming that sorry for the let me try to remove that random line in here. But so assuming that this year's PP&E is 90,000, last year's is 100,000, and you add back 10,000 to account for the amortization, it should usually be zero, right? That's the math that comes out. But if this year's PP&E is something different than 90,000, then you know that there was capital expenditures. So I hope that kind of helps, but it's really easier once you try to digest it a little bit and put it to practice, which we'll do. So here we have a modified version of the balance sheet and income statement from the same company as we used before. So you're familiar with how it looks, right? But it's only a portion of it. So we have the balance sheet on this side and income statement on this side. As you probably remember, that's how you can tell. But we only captured the portion that we need. So it's not the full thing. If you're wondering why we stop at operating income, it's because we only took the top half of the income statement. And similarly, we only took kind of the top half of the balance sheet. So here, under non-current assets, you're going to notice there's an account called plant, property, and equipment. That's PP&E. So that's all of the capital or like the machinery, facility, etc. that a company needs, right? That's the PP&E. And then notice on the income statement, they're always going to list amortization as kind of a operating expense. So here, let's quickly run through the calculation for CapEx. Okay, so we take 2025. We always start at the balance sheet. The 2025 PP&E is 350,000. Okay, and then last year the PP&E was 400,000. Okay, so you immediately notice that there's a difference of 50,000. Right, so if the amortization is not like this decrease by 50,000 in PP&E should be explained by amortization, and anything else, if there's any balance left over, it's CapEx, right? They spend more money on CapEx. So here you're going to add back amortization, as you can see, is 50,000 on this side on the income statement, and you get zero. So in this example, you can see that there is no CapEx. So if there's no CapEx, there's no unfinanced CapEx, right? Because you can't finance CapEx that, doesn't exist, or there was no increase in CapEx. So in this scenario, we're showing you CapEx is equal to zero. And when CapEx is zero, unfinanced CapEx is zero. So the only way you can have unfinanced CapEx is if you have CapEx in the first place. All right, so that's a very easy calculation, right? You just need to know where to look on the balance sheet and the income statement. So let's switch it up a bit. So we made things a little more interesting on this slide, and I've also wrote out the equation for you. So here we're going to try to deduce the unfinanced capex, right? Using the balance sheet and income statement. Again, this time, first we want to take from the current year the PP&E, which is 370,000. I'm not going to add the extra zeros. We're just going to say that's 370,000. And then we're going to subtract that from that the PP&E last year, which is 400,000, right? And then we're also going to add the amortization for this year, okay? Because remember what I said, the amortization expense gets recorded on the current year, even if it happened from last year to this year. So we're going to add 50,000, and we should get, so that is 20,000 negative 30, right? So that should be 20,000 in capex. So we know that capex is 20,000. And so now we have addressed the first three part here. Here's the PP&E. So that part, remember how that's just capex, right? So we know capex is equal to 20. But now we have to subtract financing. So for this, it's a little bit, you might be wondering, how do we know that the increase in loan, if they increase their loan, how do we know it's for capex? Well, we have to assume for a company, if they increase their debt, for a business, it's to buy PP&E, right? And that's a very wide assumption, but unless there's any information to suggest that it's not for capex, we assume that it's for capex. Okay, so here, notice on the non-current liabilities in the balance sheet, the bank debt increased from 300,000 to 310,000. So that means that they borrowed an additional $10,000. So we can use that as financing, right? And then so we have to subtract. So let's say they borrowed $10,000 for PP&E. That's financing. And then the unfinanced capex. Unfinanced capex is just equal to 10,000. Okay, 10,000. Remember how I didn't include the zeros, but I'll include it here. So, I mean, there's not really much else to say. You have to find, you have this equation. You have to find where things are on the balance sheet and income statement. And hopefully, like in the previous slides, you already have a good idea of why things are like, why these different additions and subtractions get you to the capex. And why we're deducting financing, right? Because unfinanced capex is the only thing that takes away from cash flow. Okay, if you finance it with more debt, you're not using your own cash, so you still have that cash to pay other debt, right? Okay, let's wrap up. Okay, so at the beginning of the video, I said that if you have the choice, always use the cash flow statement in order to figure out unfinanced capex. Right, the cash flow statement, because a lot of these concepts that we're going to touch on now is related to cash flow. The cash flow statement, of course, will always be a very easy and useful way to figure out, what the unfinanced capex is going to be. The only reason we use the income statement and balance sheet is because not every mid-market size company, like a company that's kind of like has revenues between 500,000 to, let's say, a couple million, they're not going to have a cash flow statement. You're only going to get an income statement and balance sheet. So it's important to know how to figure it out only using those two. But whenever you have a cash flow statement, always use the cash flow statement because it's so easy, and I'll show you why. So remember the expanded version of the formula, like unfinanced capex is just equal to capex minus financing. You can actually use that simple version of the formula if you are using the cash flow statement, because the cash flow statement under one of the categories, cash flow from investing, will actually list out exactly what the capex is for the year. You see that? Capital expenditures 20,000. I know it shows negative because the cash flow statement always shows like if the cash is going out, it's going to be a different sign than if the cash is coming in. So it differentiates by cash outflow and inflow. That's why it shows negative. But you can assume that capex is 20,000. And then the financing part, they're also going to show right here under cash flow from financing the proceeds from debt issued, which means like they got a loan and they got $10,000 from it, right? So you just have to literally find those lines, subtract them, and get 10,000. So it's much, much easier. I know we didn't cover the cash flow statement yet, but this kind of thing, it's important for me to introduce this here because uh, if you have a cash flow statement, just use that. Do not try to solve it or deduce it from the income statement and balance sheet because the cash flow statement is just so much more accurate. It's faster. And yeah, I know it's a bit on the longer side, but hopefully with the distributions and cash taxes, it will make more sense and it can be faster. So there's still 2 more elements coming, but I'll probably make those in separate videos and hopefully they're shorter. All right.